In looking at your latest monthly investment outlook, you say be careful in 2018. And one area that certainly requires caution is Bitcoin. Tell us first what your read is on Bitcoin's relentless surge to 16,000, past 16,000.
Sure. Well, Bitcoin's surge depends upon its potential for replacement or else coincidental use of the Bitcoin as a medium of exchange, a dollar-based type of currency. And, you know, for Bitcoin to do that, first of all, it has to gain momentum and popularity. It has to serve as a medium of exchange and a store of value. Now, the store of value, the price has gone up, and so obviously there's been some value there, but sooner or later it'll go up and down, and the volatility itself may, you know, inhibit Bitcoin from being a currency such as the euro or the dollar. In addition, you know, the medium of exchange that Bitcoin hopes to fulfill, you know, it has a problem because there's only going to be 21 million of them, and they're priced at $15,000, $16,000 a unit. And so, you know, buying a bag of groceries at the grocery store with a Bitcoin is going to be a little difficult.
Yeah, I love how you always can bring it back to concrete uses here. What does Bitcoin's moves tell us about the state of financial markets, global financial markets, then?
Well, the roots, I think, are based upon an expansion of money and an expansion of credit by the central banks. It's been ongoing for 6 or 7 years. You know, central banks are still writing checks in terms of, you know, buying bonds and buying corporate bonds. The ECB is doing that. The Bank of Japan is doing that still at about $1 trillion a year, although the Fed is not only cut back, but is now reducing their supply. But this expansion of credit, you know, perhaps 10, 11, 12 trillion dollars over the past 6 or 7 years is really the, you know, the foundation for Bitcoin and the foundation for other mispricings and artificial pricings of not only bonds at a negative yield, but stocks at high PE ratios.
Is it in a bubble, Bill? And I ask because I wonder if it is in a bubble and it does pop, what's going to be the spillover effect into other asset classes, into bonds, into stocks, into currencies?
Well, you know, the going up doesn't seem to have affected asset prices and bonds significantly. Anytime any bubble pops, however, it's an indication that you know, something else may follow. And so I think it pays to be cautious in terms of, you know, not only buying it, but following it as it moves up and then, you know, potentially moves back down. So when bubbles pop, whether they're small and relatively insignificant in terms of the total credit of global credit, you know, I think it's a potential forerunner for other assets. And so, you know, investors should be careful.
And this is a great point, actually, Bob, because you highlight this in your investment outlook when you look at the difference between cash and credit and say, look, when we start to see investors turning more to cash versus on cash equivalents over credit, then there's the potential here for some kind of liquidity breakdown in the system. And that's actually how you mentioned Bitcoin as one of those cash equivalents. Is that the prism upon which investors should be looking here at Bitcoin, as perhaps that divergence now between cash and cash equivalents and credit?
Yeah, I think investors are looking at it as an investment at the moment, as a mania that's fulfilling, you know, upward and upward price movements. And so it's not really a currency alternative at the moment, but with low interest rates, and in many cases, you know, $4 to $5 trillion worth of negative interest rates, ultimately investors, and I'm talking about small investors, I'm not talking about institutions that have to invest at negative interest rates, but small investors have a choice, and they can go to cash, and they can go to the mattress, or they can go to Bitcoin. And so, you know, that perhaps is the, you know, the foundation for this movement, not necessarily at $16,000 or $17,000 a Bitcoin, but maybe at its beginning, you know, down below $1,000.
Yeah, it makes total sense. I also want to talk about what you said about carry, or more specifically, the cost of carry, and people looking at the return they're chasing here versus how it compares to whatever benchmark it is that they're looking at here. And you talk about the idea that we may be reaching a turning point here, and that's why you need to be more cautious. Give us a sense of why you think we're at some kind of turning point here, and how you define being more cautious. How do you trade that specifically?
Well, thank you for reading that investment outlook very well.
The whole thing.
And it's true that any investment other than a Treasury bill has carry attached to it. A Treasury bill doesn't have any volatility, doesn't have any risk, and so it's a non-carry instrument. But anything that has risk, has volatility, basically has a carry or a higher return attached to it. When interest rates are low, or in many cases negative around the rest of the world, then carry itself becomes at risk because the instrument against which it's compared, Treasury bills, basically is selling at a very, very low yield. And so investors should be cautious going forward because carry, whether it's in high yield bonds or stocks and PE ratios or any other type of investment, carry itself is priced based upon that rock solid Treasury bill that basically yields very little. And so as the Fed raises interest rates, then carry itself or any risk investment becomes at risk.
But every investor that comes on here that's investing in emerging markets in particular here says, look, just given where the Fed's likely to take rates here, they're not expecting too much strength in the US dollar either. Actually, emerging markets this time around can be resilient. Do you push back against that principle, even in emerging markets, let's say specifically?
No, I think emerging markets have a higher growth potential, and it's in the developed countries, certainly the United States, where interest rates are being raised. Brazil just lowered its interest rate to a near cyclical record of 7%. It used to be 13, 14, 15%. So, many emerging countries are moving the other way in terms of lower interest rates, while developed countries, certainly the United States, is moving higher in terms of yield. At some point, the Fed funds rate, to my way of thinking, is going to approach 2%. And I think at that point, investors should be cautious because the leverage that's inherent in the United States and other developed countries, argues for caution as we move higher in yield. So 2%, to my way of thinking, should be a medium-term cap for the Federal Reserve.
Yes.
Bill, finally, I want to ask you about the yield curve. You've talked about it in the past. We've seen the relentless flattening of the yield curve, whether it's the 2s, 10s, or the 5s, 30s. It's not quite the reliable recession indicator that perhaps it once used to be. A lot of people say that. Do you think it's a symptom of slowing growth, or will it be a trigger for a slowdown in growth?
Well, I think the real trigger is the short-term rate, and in the past, flat curve or even a negative yield curve. It's been the central bank that's been raising short-term rates much more than 5s and 10s, and that's what produces the flat curve. In a sense, the forward markets are anticipating that the Fed will at some point lower interest rates from the current level. So I think the real indicator to look at would be real Fed funds or nominal Fed funds, closer to 2%. At that level, it's close to a 2-year, it's close to a 10-year. And at that level, it's the 2% short rate, not the 10-year at 235 that threatens the economy going forward. So the Fed should stop soon, or else the economy will slow down.
How confident are you that the Fed gets it right and doesn't go above 2?
Well, I'm not. I've been arguing against the expertise of the Fed for a long time because they're based on models, the Taylor model, the Phillips curve, et cetera, et cetera. And I think to a certain extent, even though we may have a new regime going forward, that as long as they're model-based on historical types of cyclical indicators as opposed to structural changes like demographics and credit creation, then there may be problems. So I'm not confident in the academic approach to Fed funds in its entirety.